but tends to even out over a period of time. So certainly in quarter two, it should be better than quarter one. And we're expecting as the demand continues to look up, I think there should be significantly better results that we should see in this quarter.
Sure. My second and last question on the biscuits and confectionery and on the premium dry fruits. So would you be able to strip out what is the specific growth you have seen on quarter in these two businesses? And when you mean to say that the scale up of 1 million, do you think these are the primarily top outlets we are covering, or we are scaling up across tier 1 and tier 2, tier 3 markets also?
So two parts to answer your biscuit question. We are seeing a very robust growth. So compared to last year, we almost saw 38% growth. And the revenues this quarter, as I mentioned, are 381 crores versus 276 crores last year. And they've grown 14%. So we are seeing a very strong growth across the range of biscuit offerings that we have. And there's a surge in demand for specific brands within that, like Doodh biscuit and Nariyal biscuit. So the new launches that we've done are also gaining traction. This is, of course, very early, but we're seeing the repeat orders. It is driven by two core strategies that we have. So one is on the distribution expansion. So several sort of spaces which were almost white or were less covered, that coverage continues apace. So a lot of it is smaller towns, and the focus is a lot more, while urban areas tend to have a very solid demand, but we want to expand that. And the mix of offering that we have for the urban areas, especially the larger cities, is undergoing a change, and which is what the core work is right now going on. And the mix of, for example, the premium biscuit that we have offered, the biscuits within our portfolio, which tend to have a larger consumption pattern in the large and urban sort of areas, that big focus is going on in terms of expanding our distribution to urban areas. So the idea is that our margin on the biscuits business was about 10.1%. The idea is that we move up the margin construct of the biscuit business by higher price point products and more sort of brands which are appealing to the consumers who are looking for that offering. So that is one part. On the dry fruit side, Patanjali is already doing the dry fruits. We are working right now on a strategy to give a premium offering on the dry fruit as well as the mass market side, and continue to evolve and develop it, in a way that the offering is more vibrant, because we're witnessing a strong growth across all the segments. So we're working on supply chain. As I mentioned, that we tied up, with very large sort of suppliers, out of the US. We're looking at more suppliers as they're coming on stream, and building up a supply chain capability. And the offering, the launch we've already done with the Nutrela Max Max, so that you will see on the shelves now. And we are pretty confident that this category will be one of the larger categories. We're going to expand the range by offering the coated offerings and flavors. We're looking at dates to be added very quickly to the portfolio. So we're pretty confident on dry fruits as a category within the food for a longer term sort of growth momentum.
Thank you, and all the best, sir.
Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may press star and 1 now. We'll take the next question from the line of Akhilesh Bakri from an individual investor. Please go ahead.
Hi, thanks for the opportunity. Initially, I would like to congratulate you and the team for a very healthy performance on the foods business. But unfortunately, this edible oil business seems to extend a lot of volatility in our numbers. So I wanted to get your thoughts on what synergies exist between the edible oil business and our foods business, and whether these businesses could be separated going ahead, because every now and then, in some quarter or the other, this business may take away the attention from the performance of the food business.
Yeah, no, that's a great question, and I just want to highlight that edible oils as a business is a good business. And because of the reporting sort of timelines, that the companies have to follow every quarter end, which I sort of spoke during the call also. So many times there's a lag between how the markets respond and where the markets are headed. So, for example, that if the prices are rising, the domestic, and there are three elements to the way prices operate. One is the domestic Indian market prices that we have. Second is the international market, the physical market from where almost 70% of countries' requirements are imported. And third is how the futures market behaves. Because of the lag in the sort of timing of each of them, there might be windows in which the market may give you a shock. Market may sort of tend to give you a lower, sort of by the margin, or maybe also may mean a negative performance. But it evens out over a longer term window always. So as I mentioned in my call, that the performance of quarter one will certainly tend to even out. We are pretty confident that we'll meet the objectives that we set out for the edible oil business. But coming back to the more important question, that does it fit into our foods business strategically? It does very well, because there are two parts. There's a lot of commonality of distribution that we have in the urban areas, while a lot of oil sells to kirana stores and sells to B2B. But our 80% business of ours is almost in the branded form. And most of the brands are selling to where India consumes, whether it's the modern trade, whether it is e-commerce in a smaller way, or it is the kirana stores, or multiple different channels to which the oils are selling. So there's a lot of synergy that we have between the two. And both in terms of the return on capital that the business generates, in terms of cash flow that it sort of allows us, the strength company has, and the way we have been growing. Because there's a lot of consolidation which is happening as well. So our growth momentum on volume terms of nearly 30% plus that you've seen. Typically, Indian market is growing between 3 and 4%, or 3 and 5% occasionally. So our growth, which means that we are taking the share away from smaller players. So this will take some time, but this consolidation in the longer term will be very helpful for companies' longer term growth momentum. So I feel that not only should we stay with the business, but we should continue to expand and make it a more predictable one.
Thank you for your answer. Going, on the same topic, could you also elaborate between the linkage between our oil palm business and the edible oil business as follows? How much percentage of the overall edible oil business is from palm oil? And as on date, how much percentage of the palm required for that business are we getting from our, own nurseries and our own palm plantations?
Sure. So oil palm plantation, we nearly get about, currently, if I were to do the numbers, we get about 10% from our own oil palm plantation that we have in the edible oil segment. And going forward, in the fullness of time, when we have the entire 500,000 tons planted, I'm expecting that nearly 70% will come to our oil palm plantation business of the palm oil requirement. Now, why is it critical that we the integration of the two businesses is important? That not only on a standalone basis, the oil palm plantation is a consistent generator of between 16 to 18% of EBITDA. But when you look at the synergies of directly servicing our domestic requirement, there is a lot of value in integrating that with the refinery business and, the consumer business, the branded business, the house shelf. So the vertical integration in a lot of ways brings in added efficiency and added value for the company. So both the things are very synergistic. Standalone oil palm plantation businesses in India certainly will struggle, and while they may make margin, but their ability to leverage the margin for expanded growth on the overall business itself will always be limited as a standalone player.
So will it be fair to say that as more and more share of the palm oil business comes from our plantations, the volatility in our overall business would also reduce, because you would have, a certain cost base for the palm plantations, which will not be as volatile as the palm oil prices are every quarter and every month.
That is correct. But I just want to highlight one important point. So to your first point, whether it will reduce the volatility and otherwise, absolutely. But the way business is run, that the higher the oil palm prices, the better off it is for the oil palm business, which may or may not necessarily be very good for the edible oil segment. So having said that, in general, I would expect that the more we have the predictable, the domestically sourced palm oil, it will have a significant value add for the company because we'll be less exposed to global uncertainty, and it will assure on an integrated basis much better margin construct.
And this 70% figure which you mentioned, is that possible by FY27 or by when are we targeting?
So by FY27, this will have a actually gradual increase every year, but this should take almost 7 to 8 years before we can expect 70% of oil palm plantation to start coming in. It will be probably closer to 55% in year 7. It will build up, but in year 10 onwards, it will be nearly 70%.
Thank you, sir, for that.
Thank you.
Thank you. We'll take the next question from the line of Bharat C. Shah from ASK Investment Managers. Please go ahead. Mr. Shah, I have unmuted your line. Kindly proceed.
Yes. Asanaji, continuing from the previous question, strategically, how do we see long-term the construct of the edible oil business? What kind of likely growth rate, margins in a more normalized basis that should prevail? I understand that last year has been a particularly unusual period, second quarter of the last year, and through that period, even till last quarter, the picture is being somewhat volatile. But on a more normalized basis, how do we see the long-term construct of the business? What kind of margins? What kind of growth rate for the industry, and what kind of the growth rate for us? And therefore, what kind of return on capital employed in a more normalized basis we expect to earn?
So I'll start with the last question first. In terms of return on capital employed, it's a good business because there are nearly 6 to 7 turns we can take on the working capital deployment. And the business at 3% with 7% is nearly 21% return on capital employed. But I would say that let's take it at even 3% and 6 turns, it's about 18% return on capital, which is a good business to be in. That's what I've repeatedly sort of said before also, that edible oil business in a particular quarter on absolute terms may give a shock once in a while and may not be consistent because of the way the reporting is done. But overall, from a return on capital, from the distribution structure that is in place, from the opportunity of a steady cash flow that it provides, and our long-standing strength in this business of a long legacy of Vichy Soya, erstwhile Vichy Soya, and now Patanjali Foods, the consolidation in the industry because of the larger working capital sort of requirement the edible oil business has, the need for brand and distribution, having large teams, etc. There is a consolidation which is being witnessed in the edible oil space. That tends to help all the larger companies, and we are also beneficiaries of that, which is reflected in the volumes that are growing. Coming to the growth rate of the industry, in general, the growth rate has been between 3 and 5%. There have been occasional windows, especially during COVID times, when it was flat to marginally negative. But overall, I expect with the growth in country's population, the current place at which India is placed on the average consumption per capita, and the way we've got examples of the US, which which is, of course, very evolved and developed. But if you were to take China as well, and there is a substantial sort of headroom for growth in the edible oil segment. And we wish to grow, and so we are not growing the volumes at the cost of profits. So we want to keep a pace on the volume front, and which is why you would notice that the longer term the revenue projections and all that, we are neutralizing the edible oil revenues and only looking at the volumes and ensuring that our FMCG businesses tend to are the ones which are focused in terms of the revenue growth. The margin construct, as I've repeatedly said, this business is good for between 2 and 4% of margin. And in a good quarter, it can be 4%. We've earned up to 8 and 10% also, but those are outliers consistently for 2 years when the markets were on a growth momentum overall worldwide. We also benefited. And there have been periods when the market, we've lost money also. But overall basis, it would be safe to assume that in a year's time, between 2 to 4% is a good number to go with. And even this quarter, the change that you saw and a drop in margin, we are reasonably confident of covering it back during the year. So I would only urge, the way we look at businesses, that we would work on the strategy, not forced by the quarter-end sort of numbers what are coming out, but ensuring that the predictability of margin over a period of time is ensured, that we don't have any major shock in how we manage the business.
Right. No, so I was looking at over last 11 quarters of the margins. So clearly, what you're saying is right. Last year, second quarter was the one which was a rude shock where the margins were badly impacted and were negative. And the first quarter of the current year has been a second period. So in the 11 quarters that I've seen, that has been the case. I presume these last 1 year probably is more unusual. And on a more normalized long-term basis, this kind of high frequency fluctuation probably is not the normal character of the business. Am I right in understanding that?
So that is absolutely right. The last year, quarter 2, was unprecedented. It was nearly it happened after 3 decades, this kind of volatility, which was not witnessed before. And all the global players, the best of companies globally, the largest companies in the world, got the shock, in terms of the way markets reacted. And this was very little in control with the companies could have had. The actions on regulatory actions in Indonesia, the war in Russia, Ukraine, etc., it happened. Even this quarter is pretty exceptional because with the pace at which the futures market sort of tended to move up, and the domestic market on account of supply and demand were at a lag. This happened, but I would say that these are more instances of certain windows in which this may occur. But in normal course, over 3 years, you would have seen, companies performing like Patanjali Foods itself, that we did not have any particular quarter in which there was such an unprecedented change in the markets moving in very divergently compared to each other. So there tends to be some bit of correlation. The correlation in certain windows is very strong. In other windows is less strong. But that is a part of the science of managing the business and also the art of managing the business and the experience that comes in. So we feel pretty comfortable in where we stand right now and feel reasonably comfortable to say that by the year end, we should have normalized this first quarter result and should be pretty much on pace for the growth plan that the company has.
Right. Which means if you have to make a long-term kind of a model of the business, then industry growth rate about 3 to 5%. Our record and our ambition is to do better than that. So maybe presumably 5 to 7%. Will that be a fair number for our growth rate?
That's right.
So if it is 5 to 7% growth rate with the margins normally ranging between 3 to 4% in tracking year of fiscal 2021-22. Each of the quarters that I saw, the margins were in excess of 4%. So let's say we take 3 to 4% kind of a margin, and with a scale over the period of time, some amount of maybe improvement. Therefore, return on capital employed at 7 times turn should be somewhere in the vicinity of 21 to 28%. Will that be a kind of a fair summary of long-term future? Plus, the fact that we will be integrating our own palm oil more and more into the mix, and therefore, even if there is some volatility at some stage, there'll be, let's say, corresponding neutralizing factor in the internal palm production. So, relative more stability going forward, and margin construct and the ROC in that band. Is that kind of a picture we can kind of build into the model?
I would say that that would be the fair reflection of the numbers, Bharat, and we are pretty convinced that, and not just convinced, that the business has intrinsic value for players who are large, for players who've got distribution, with infrastructure that we have built over a period of time, and the inherent nature of the business. So, gave 21% return on capital, margin construct of anywhere between 2 and 4%. You are saying 3% is the midpoint. That's reasonable assumption to make. And the integration of the palm oil business, especially with the oil palm plantation, progressively as we go forward, is going to benefit the company immensely. And this is something that we are striving for as well, to bring about that level of predictability that you speak about in terms of the business model. The only thing I would say here, the caveat is that there might be windows in which a month or 2 months or 3 months, 1 quarter in a year, which would give us some divergence in terms of the predictability, unlike an FMCG segment, will give us that change, and which we have to deal and manage. I think that is the only part I would say. But overall, in a year's time, that if you look at a 12-month window, we should be pretty consistent with what you just now said.
One last question. While talking, your voice was not very clear, so I did not probably fully understand. But you mentioned that there were some 71 or 72 crore of credit losses, and which have been reversed in the current quarter. Is that what you said? Can you explain that a little better?
So what happened was that on account of the Ind AS standard, that out of our debtors, we had to take 71 crores of expected credit loss in the books. So our actual P&L should have been higher by 71 crores, but because of this reason of Ind AS and the regulations, we had to take that into account. So that was just an accounting entry that had to be done at the quarter end, which has been reversed in this quarter. We're expecting this change to be nearly between 63 and 65 crores, which is already written back in the books of accounts in this quarter.
Oh, I see. So it was ECL based on Ind AS that you had written off. Expected.
Yes. But I would like to clarify it. As per Ind AS requirement, we have to define the defined credit policy for the customers, and we have defined in the books a particular credit period for our customers. And you can say the payment has been received slightly delayed by 2 or 3 days, not on 30th of June. That's why, as per Ind AS requirement, we have provided the expected credit loss. This payment has been received in the month of July itself, and we are going to reverse it as per law, as per accounting standards. So this is the fact.
Yeah. Thank you, Rajesh. Thank you, Ashtar.
Thank you, Bharat bhai.
Thank you, sir.
Thank you, sir. Thank you. Thank you.
Participants who wishes to ask questions may press star and 1. We'll take the next question from the line of Kuldeep Gangwar from ASK Investment Manager. Please go ahead.
Just regarding this credit loss part, when you are recovering that number, it will be part of other income or any other line item?
Rajesh ji?
This is part of other income, basically included in the other. No. This is right now included in the other expenses, and while reversing,
Yeah.
While reversing, it will include in the operational income, not in a part of other income.
Operational income. Okay.
Yeah.
Second part, can you please provide the breakup of FMCG business sales and margin in the major subcategories in Q1 FY24?
So Rajesh ji was giving, or I can give as well?
You can give, sir. No issue.
Okay. So in terms of breakup of the FMCG business, in terms of the Nutrela, which is a soya protein, it is 155 crores. There's a growth of 3%. In the foods division, we did 1,354 crores. Last year, of course, this business was not with us, so it is against that backdrop. The biscuits did a revenue of 381 crores. This is against 276 crores last year in the same quarter. And nutraceuticals did 62 crores in this quarter.
And how was the margin profile across categories?
So the margin profile in each category, in the soya protein business, we made 13% margin. This was at 20 crores of EBITDA. Food division, we did 266 crores, which was 19.71%. Biscuits, we did 39 crores. And nutraceuticals, we made 36 crores.
And what should be the full year expectation overall from the FMCG business in revenue and the margin profile?
It's pretty much on course for that. I think our target always, as we mentioned, is between 16 and 18%. We are doing right now better than that because there have been some positive wins that we've got. But overall, I think looks like that we might be closer to 18% plus than below that.
Sure. And should we assume the Q1 FY24 sales of FMCG business can be annualized? Like whether there is any seasonality in the business or it's pretty much stable across quarters?
Your voice is slightly muffled. Can you just speak a little louder?
So I'm saying Q1 FY24 sales in FMCG business can be annualized, or is there any seasonality in that particular business?
There is some seasonality. So very clearly, like for example, the nutraceutical and biscuits would not have. Soya protein business have marginal seasonality, and the food business will have. So for example, in the festival season, the sales tends to pick up, and a lot of these products are meant for sort of winter months. There are products which are meant for summer months. So there would be some bit of seasonality there, but not any dramatic seasonality.
Okay. And is there any seasonality in oil plantation business?
There is a high seasonality. So there are periods in which, in some quarters, when the harvesting of the fresh fruit bunches happens, so you will get in certain months much higher, and that's what automatically translates into the yield. But overall, so yes, it will have in about 6 months when the harvest is happening, we'll have peak, sort of lot more revenues and EBITDA getting generated. And in the other quarters, the EBITDA will tend to be lower. But overall, margin construct of, again, as I mentioned, 16 to 18% is a pretty consistent margin and very safe to always take in our calculation on our palm plantation business.
Also, which are those quarters where higher contribution from oil plantation comes into the picture?
So this quarter will be higher contribution, and as we are getting into the harvest season, as well as it will just go forward into the next quarter as well.
Sure. And you were mentioning about, say, edible oil business margin. So full year basis, can we still assume that it's a 2 to 4% range is doable for full year basis in edible oil business?
We feel confident, Kuldeep, as I just mentioned in quite detail. the targeted margin construct of between 2 and 4%.
आपण ज्या व्यक्तीसोबत बोलत आहात त्या व्यक्तीने आपला
So not only, so we are still pretty much, we feel confident that the full year between 2 and 4% we should be able to sort of generate EBITDA margin in the edible oil business.
And sir, depreciation has increased from 43 crore last quarter to 58 crore in Q1 FY24. What are the reasons for the same, and what should be the going run rate for coming quarters?
Yeah, Rajesh ji. Rajesh ji?
I believe he's on the other call right now. So.
Okay. So I think the run rate typically has marginally gone up on the depreciation side because we've acquired certain other assets, and there the depreciation has been taken in this quarter. But normally, I think during the year, we should have close to about 170 to 180 crores of depreciation. I can Pradeep get you the exact number. Right now, we're not sitting opposite each other.
I am on the line.
Okay. Kuldeep had a question on depreciation.
Rajesh ji, this depreciation figure increased from 43 crore to 58 crore in Q1 FY24. So reasons and what we should expect going forward?
Actually, this depreciation, we have made some alignment to the asset which are lying in our fixed asset register for pre-CIRP period was revalued during the CIRP period, pre-CIRP period, and right now we have aligned this with the Companies Act. So depreciation has been increased by 28 crore for this quarter, and near about 10 crores of depreciation is additional in this quarter. So going forward, this will increase by 15 crore from the past quarters as compared to the past quarters.
So coming quarters, 50 crore should be the run rate ballpark in next 2-3 quarters, right?
Yeah. 15 crore will be increased.
Okay, sure. And last bit, like distribution reach currently, and what should be the target in next couple of years?
So broadly, we had, as I mentioned, that in our presentation earlier, that we currently have 1.5 million retail outlets which we reach directly in all the businesses combined. There is an indirect reach that we have close to nearly 1 million retail outlets, and the target is that we are on continuous expansion path, as I mentioned in the biscuits and nutraceuticals. So we're adding distribution outlets at the rate of nearly between 10 and 15,000 every month. And so that work is going on. Much larger part of the work is going on in the biscuit business. Nutraceuticals is more special, more sort of different strategies being followed. Our focus is a lot more on the e-commerce and D2C. So it's safe to assume that we'll add every year anywhere between 150 to 200,000 retail outlets in our reach.
Sure. Thank you. Thanks a lot.
Thank you.
Thank you. We'll take the next question from the line of Akhilesh Bakri, an individual investor. Please go ahead.
Yes, thank you for the follow-up. Sir, one suggestion, if you could include this category-wise revenue and EBITDA margin on the food business in your result release itself, it would be helpful for everyone for comparison's sake. And my question is, this 71 crore credit loss which you mentioned, which will get reversed, was it for the oil segment or was it for the foods business?
This was for the foods business, but Rajesh, you can elaborate.
Majority is from the food business.
So is it fair to say that the EBITDA then for this quarter for the foods business would have been higher by almost 50-60 crores actually?
Yes.
So actually our EBITDA margins would be even higher than what we have reported currently on the foods business?
Basically you can't say like that, because this is a penal interest which this is a penal clause which requires the treatment of expected credit loss. So operationally, if it would not be there, this has been shown into the other expenses. So EBITDA margin could be higher if we consider that, up to some extent relating to the food business.
All right. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Sanjeev Asthana, CEO, Patanjali Foods Limited, for closing comments. Over to you, sir.
So thank you very much for patiently listening to to our sort of result for the investors. We continue to work towards stabilizing the sort of margins in the edible oil business, where the focus and target is on managing the risk to ensuring that we maintain our steady pace of the commitments that we're making. The company continues to strive and work towards the FMCG businesses, and we're quite pleased with the progress. There are few of launches that we've lined up. We continue to work on those, and the suggestions that we get in terms of reporting and giving out better quality reporting, we treat it with a lot of respect, and carefully we'll consider, and we'll certainly start making it better and which is more consistent with the requirements the market has. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Antique Stock Broking Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.